Good afternoon, folks, and welcome to Executive Insights. I'm Ollie Chandhok, the president and publisher at the Dallas Business Journal. Earlier this year, we talked to Clark Briner. Clark is the founder and CEO of Revere Capital, and today we're going to meet Andy Cooney. Andy is the managing director of specialty finance at Revere Capital. Andy, welcome to the program.
Thanks for having me.
Very, very excited to have you here and learn a little bit more about the business. We talked to Clark, like I said, and now we're going to learn a little bit more about one segment of the business. Tell me about your role specifically and what you do each day.
Maybe just 30 seconds on Revere Capital in general.
Sure.
Revere was founded in 2006 by Clark Briner, and for the first 10 plus years did private credit real estate lending, generally shorter term loans to real estate developers. And then in 2017, they came across their first specialty finance type loan. And now we're a team of 6 people focusing on specialty finance. Now, what we refer to as specialty finance is really lending to lenders, and typically non-bank lenders. If you think about a bank, they have a capital base, an equity base, and then they get additional money to lend out through depositors. Sometimes they'll borrow in the markets as well, but typically through deposits. Non-bank lenders don't have the benefit of having government guaranteed deposits to lend out, so they need companies like Revere.
Gotcha. Now, private credit seems to be used as a catch-all phrase for many different types of, like you said, non-bank lending. Specifically, what does Revere Capital do in this private credit space?
When people talk about private credit, they're generally talking about cash flow lending. And what most cash flow lenders will do is to look at the projected expected cash flow value that a company's going to generate, and they'll lend some multiple of that, maybe 3 to 6 times. Those loans can be senior and secured, but the actual assets securing those loans, usually a fraction of the amount being lent. Revere does just the opposite.
Okay.
Our borrowers come to us with their loan portfolios. We evaluate those loan portfolios, and we lend to them based on what we think those portfolios are worth. Their existing assets on their balance sheet, what are they going to pay ultimately?
Gotcha. Okay. So how does lending to lenders differ versus lending to commercial enterprises?
So lending to lenders, each of our borrowers, they typically have a specialized niche. Maybe it's small business lending, maybe it's auto finance, and they're going to design their individual product based on what their target market is. Okay. So what we do is we take a look at their portfolios. We go back multiple years, usually through multiple cycles, and we see how those portfolios are going to perform over time. Once we take a look at that analysis, we'll determine just how much we want to lend on that. Mm-hmm. Sometimes it can be as low as 60%. Sometimes it's as high as 90%. There are a lot of different factors involved. But we're lending a fraction of the assets on a company's balance sheet as opposed to a multiple of cash flow, which is what the cash flow lenders are doing.
Gotcha. So super thorough analysis. Now, what types of collateral and borrowers are typical for your business?
With regard to the collateral, first and foremost, we want self-liquidating assets. If you've ever taken out a loan, you know you've got to make a certain number of payments over a certain period of time, and then that loan is gone.
Yep.
And that's what our borrowers bring to us from a portfolio standpoint. The second thing we love is granularity. We want hundreds or even thousands of loans in our borrowers' portfolios. That assures us getting some measure of diversification. We can diversify by geography. We can diversify by obligor. We can diversify. If it's a small business loan, we can even diversify by industry. The more diversification we have, the better performance we're going to have overall. Once we take those 2 items, then we look at the actual type of collateral, and we've looked at dozens. Mm-hmm. They're the basic, there's auto loans, there's secured, unsecured consumer. We've looked at supply chain finance. We've looked at medical receivables. We looked at royalty payments. Any number of types of assets are doable. Yeah. As long as we've got contractual cash flows, we can usually structure something that works for the business.
Gotcha. Now let's talk bigger picture. Talk to me about the competitive landscape in specialty finance, and how does Revere distinguish itself from your competitors?
Specialty finance lending is like any other kinds of lending. So there are people who go after the big deals and people who focus on the smaller deals. And what Revere does is we really want to be that first institutional capital that a company takes on. So maybe they've been funding themselves through friends and family, any number of ways, but when they come to us, they're looking for a more structured facility and a facility that they can grow with. So our target borrower would be 10 to 20 million in terms of an initial facility. We've grown with companies up to as big as 50 million. At some point, they're going to attract the attention of someone who has cheaper capital or is willing to give them a higher advance rate. Yeah. And we'll shake their hands and congratulate them, and they'll move on and we'll start over again. So we like to be the first institutional capital. We get a little bit of a complexity premium in terms of pricing because there is more work to do on that upfront facility, and there's a little bit of training of the borrower and retraining of us every time we bring on a client.
How have the issues in the banking market and the 500 basis point move in rates impacted specialty finance over the past couple of years? And how do you think the Fed's easing will impact the sector moving forward?
So let's start with the 500 basis points. Coming out of a period of basically zero interest rates for an extended length of time, 500 basis points it's an incredible move. And it's not just the amount of the move, it's the time frame with which they did it.
Sure, yeah.
So 500 basis points in 12 months. And that's a difficult amount for any business to absorb. Any lender makes money based on the spread at which they lend versus the spread at which they borrow, right? And if it compresses that quickly, you've got to have the ability to refinance your portfolio. Thankfully, most of the people in our portfolio had either the pricing power or shorter term assets that rolled quicker and they could reprice as the rate increase was happening. Another interesting benefit, I say benefit, of that 500 basis point increase is leading up to the increases. There were a lot of business models out there because of the extremely low rates that were surviving and making profit with business models that made us think, I wonder how this is going to perform in a normal interest rate environment. Well, that 500 basis point move answered the question in a lot of cases. Zero interest rates, there was a little bit too much excess happening in certain segments. Yeah. That 500 basis points squeezed a lot of that out. It exposed some business models as unsustainable, right. And in a lot of ways cleared the runway for us a little bit going forward. We're actually very optimistic. I think the 50 basis point cut is certainly the first of what will likely be several. That certainly takes some of the pressures off our borrowers, lowers our ultimate returns, but what we want is healthy borrowers. Yep. We continue to look for signs of slowing in our borrower portfolios, and we don't see it yet.
Wow, okay.
I think the pressure is more at the non-prime space, and we're not really seeing it in our small business lending portfolios and among some of our other borrowers. So we are optimistic about the rest of 2024 and certainly going into 2025.
So can we expect more cuts in 24?
In 24, I think after the election, I think you'll probably see one.
Gotcha.
And then going to 2025, we'll just have to look and see what the data is going to do.
We'll see what happens. Well, Andy, thank you for spending time with me. I always learn something from Clark and from you, and this has been a wonderful conversation and really enjoyed getting to know you more.
Thank you.